Hello everyone, and welcome to the episode number 8 of JustDario Cigar Time. So today I would like to talk about December and what's usually the best approach in markets for the last month of the year. But also I will try to do my best to put all the elements on the table for a fair assessment of the current situation and how I believe the last month of this incredible year in many aspects should be approached for the best and with the intent of not getting damaged, with the intent of perhaps making some extra money and start 2025 with the right posture. Okay. So, first of all, December in general tends to be a month among professional investors, from brokers to banks to insurances and so on. Tends to be a month where everyone tries to do the least amount of changes possible in their allocation postures and whatnot. The reason is pretty simple, okay? That no one wants to risk spoiling their yearly performance just before the very end. And if you spoil your performance in the last month of the year before bonuses, promotion, and everything else is meant to occurs, you may end up being burnt, okay? So in a market where everything is more and more driven by passive investing type of dynamics, as we discussed in previous episodes, even among those asset managers that pretends to be active, but in reality they're not, you really cannot expect anything to change in this huge amount of investors in the last month of the year. So everything there is gonna run as usual. People will continue following momentum, making some tweaks here and there, and strategize for what's gonna be 2025. That, fairly speaking, looking at what people are saying on mainstream media, what Wall Street analysts are writing in their own research or whatnot, at the moment doesn't look like it's gonna be any different, to be fair, even considering Trump coming to office. As a matter of fact, most of the investment banks didn't really change their outlook that much, in particular with regards to US. However, what they did is to include in their very bullish research still across the board some disclaimer here and there about economic tariffs, maybe about Trump unpredictability, maybe about situation in Europe that it's checkered, to say the least, and about Asia, China, and so on. But overall, you can see everyone remains bullish and didn't really change much, to be fair. Okay. The winners of this year are going to be expected. The winners of next year, Mag 7 still is going to be the trade that no one can afford to fade, blah, 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 and the usual things. Okay. So don't expect any particular actions from professional investors, Wall Street, and whatever in the last months of December, unless they're forced to, okay? I wrote this week about so many gray rhinos out there. We have SMCI, troubles with the Nasdaq exchange. We just had the latest financial earnings of Dell Inc., where the company effectively highlighted that there are delays in NVIDIA Blackwell shippings. And as a matter of fact, these delays will imply that there would be no real really meaningful sales of this GPU in the last quarter of the fiscal year for the company that became the darling of this bull market. We have the situation in France where there is a government crisis. Like, frankly speaking, like, I believe that once again, the current narrative is too much overblown. Like, comparing France to Greece at this stage, it's still a bit too far-fetched. It's true that the direction is rather bad, but honestly, there are way worse situations in Europe than France. And personally speaking, if you compare apple to apples, if you compare the industrial system, if you compare commercial system, if you compare balance of payments, and if you compare the health of the financial system, honestly speaking, Germany is in a much worse place than France is. But Germany still holds this reputation that they are very trustworthy, they're a strong economy, that they don't do deficit, they don't pile on debt, blah, blah, blah. Is it really true? I'm not 100% sure, because as a matter of fact, Germany in the past several decades increased the public debt, not as much as other countries did, fine, but the private debt in Germany is actually quite huge because of this sense of security in the strength of the economy, because of this sense of security in the strength of asset values, because of high reputation that Germany repays their debt and whatnot. It has allowed German citizens to really leverage themselves a lot. And there is a great bubble out there, starting from the real estate area, going through the industrial area that honestly is falling apart, and the valuation that they're still attached to in the market don't make sense at all. But, as we're used to right now, stock indexes are not anymore a good proxy for the performance of the underlying economy in what is an incredibly financialized market. Then we have other risks like geopolitical risks, China, Taiwan tension, Trump, they can tweet anything at any moment. And who knows, like in a market that is so overextended, if anything out of the blue happens, imagine everyone that is currently standing on one side of the boat, rushing to the other side of the boat. What happens to the boat? The boat starts twisting significantly. And the bigger the movement in the boat, the higher the chances that this boat can actually capsize. So this is actually a good picture to bear in mind for these markets right now. So everything looks so calm. Everyone is currently positioned to enjoy a great Santa rally. Actually, if you see the positioning in long S&P 500 contract right now, it's through the roof. I mean, people, they don't even think in the back of their minds, that something can happen. Like, what can happen in December? Like, people just think about going on holiday, close the year, usually there is not much happening. So what can spoil the party? Like, so, like 8 times out of 10, December is always a great month. So why not going all in and perhaps piling up some leverage too? Well, someone might not be agreeing with this view. Of course, we don't know the name, but what happened this week, and honestly, I was particularly impressed by how wrong the mainstream media narrative is on this. So the mainstream media narrative claims that the current strength in the JPY is due to traders betting on a Bank of Japan rate hike. I mean, the government of Japan that is currently running a massive deficit into a tanking economy with a shrinking population, and they carry the largest amount of debt GDP in the world. they just announced they will increase their debt by 6 trillion yen plus 1 trillion more to support Ukraine. I mean, Japan support Ukraine. This is a bit quite hard to understand, considering that in Japanese constitution, like, they are against any type of war, to the point that they didn't even have a real army till recent times. Okay, they just had a defense army, but apparently now Japan it's supportive of our efforts. So, overall there are 7 trillion of additional debt in a government that it's running already in a deep deficit. Okay, with the latest inflation data shows that inflation in Japan is already at 3% in the major area. And these are the official data, okay? With interest rates kept artificially around 1% and very low by the Bank of Japan, people in the mainstream media think that what's happening is because traders believe that a rate hike from the Bank of Japan is going to strengthen the JPY. I mean, in what kind of cave these people are living, okay? Clearly, when rates are so low and when the growth amount of debt is so large and they keep printing money to finance that debt, how on earth hiking interest rates can be the reason why the JPY is strengthening so much in the past week? Of course, that's completely wrong. And as I explained in an article before, if yield increase in Japan, actually the JPY counterintuitively is gonna lose value faster because the Bank of Japan will need to print even more yen to pay for the interest on the existing debt. And then when the existing debt is gonna be refinanced at higher interest rates, this is gonna have a snowball effect that is gonna devalue the JPY massively and in a parabolic type of way. And there is no amount of dollar reserves that can stop this. In particular, when the fair value of those US Treasuries reserve that Japan has at the moment is literally being killed by inflation in US. So, I mean, there is no escape here, okay? So that narrative is completely wrong. What's really happening here is that someone big enough to move the market in such a magnitude is the leveraging, okay? Is the leveraging is JPY carry trade, okay? Hold on a second. Didn't we just say that December is going to be, just sit there and enjoy Santarelli? What can happen in December? Every time December, you end up making money. People they dress their book for the year end so they can clip great fees and get paid good bonuses, blah, blah, blah. Well, this is actually very strange to happen right now. For someone out there to significantly reduce their risk at this time of the year doesn't happen, doesn't happen that often. So, and the most interesting thing at the moment is that there has not been really an impact on the markets. I mean, on Friday, US stocks were open for half a day and they just closed at another all-time high. I mean, of course, why not, right? So where is the shoe gonna drop? In Japan, difficult, okay? Because usually the purpose of carry trade is to invest in foreign assets. There have been also some leverage trade within Japan, in particular in the equity space, but in terms of magnitude, it's not comparable. Someone is taking off his position from Europe. Well, there might be a case there. However, the truth is that the European market hasn't been performing that well because now that Trump is going to be the next president, and everyone knows that Trump really doesn't like the fact that Europe for decades now has been effectively living off the US, enjoying the NATO alliance without even contributing much into that, right? So while everyone thinks that China is the main target of Trump, while China barely exports like 5% of everything into the US. In reality, what's badly exposed there is Europe, okay? So is this person taking off leverage worried about Europe? Maybe, but to be fair, not much JPY carry trade went into Europe. And the reason for this is that the stock market in the long term, they didn't really perform that great, but in particular, most of the carry trades went into high-yielding environment, and Europe held rates at negative till not long ago. And stocks had such a negative equity risk premium that didn't really make much sense to leverage to invest in such an economy where the growth potential has been chronically limited through the years, mostly due to a lot of poor decision taken at the administrative level and an insane amount of bureaucracy that effectively is a hinder in the growth of the economy. That's shooting in the foot. So talking also by personal experience, most of the JPY carry trade has been targeted on US dollar denominated assets, either bond or stock, even if, to be fair, the proportion is, I would say, 2-8, if not even 2-10, okay, where the lower part, of course, is stocks, and the most part is bonds, from corporate to CLO to MBS and so on, okay? So now we have this movement in the market, okay, right at this time, with all these gray rhinos going around, and a market overall that is incredibly bullish for the month, in particular in stocks, okay? So I believe that, considering everything, what's going to be the best posture for the next 30 days is effectively trying to be mindful, okay, of not falling for the Santa Rally FOMO. Perhaps take the chance of increasing cash a little bit more, in particular when on January there is going to be likely a lot of tax selling, So January, as it looks right now, is going to slow down. And then in January, Trump is going to officially be in the office. Okay? So here we go. The rodeo resumes. Again, everyone is going to be attached to Twitter, to Truth Social and whatever, to make sure, if he tweets something during the night, market is going to move and blah, blah, blah. And here is the point I wanted to get to. Volatility. At the moment, and for a while now, to be fair, there is an incredible gap between government bonds, particularly US Treasuries, and stocks volatility. I mean, stocks volatility is currently through the floor, and volatility of what are supposed to be risk-free assets is much higher on a relative basis. The last time we saw this type of gap to remain that persistent for a while, it was before the GFC, okay? Doesn't mean that something is going to happen in January, something is going to happen in December, something is going to happen in February. Well, timing is impossible, but the longer this gap stays in place, the higher the chances problems somewhere in the system are mounting, okay? In particular for what regards the real value of the assets that financial institutions have in their books, okay? So the fixed income market tends to be more cautious than the equity market, because in fixed income, you can lose 100%, but your gains are limited, right? They're limited to the coupon that you can make. While in stocks, everyone dreams to make 100%, 200%, whatever, okay? So the approach is very different. So you can see the fixed income market is on a much higher alert. Furthermore, what is interesting, if you currently see the positioning, there is a very heavy positioning for 10-year US Treasury yields to move towards 4.9% very quickly. That's a hell of a move, right? In particular, when the Fed is expected to cut rates again in December. I mean, if the Fed cut rates, effectively the US Treasury yield curve is going to be completely uninverted, including the 3-month to 10-year spread that is, as I said many times, is the equivalent of the Titanic hitting the iceberg when it inverts. Okay? So currently the volatility is too low. The stock is the long-term average VIX is around 19.5. And currently we are chronically much lower than that for so long. Imagine a market where, as I said at the beginning, everyone is on the same side of the boat, not only in regards to positioning to being bullish, but also with regards to being short volatility. Harvesting volatility has been perhaps even more profitable from Wall Street than going long stocks in recent times. Okay, it's a trade that 9.5 times out of 10 you win. The problem is 0.5 times you go bust. And this is the funny thing, is that Trump effectively increases uncertainty and it can trigger volatility. As we saw briefly this week, he posted a tweet about tariffs on Mexico and China and Canada. And immediately people started to freak out, like futures started to sell off and so on. Okay. And then quickly you had a statement from Chinese embassy in the US that was, reconciliatory. The market quickly started to, think about that, first of all, we know this is a negotiation tactic that he uses all the time, but he's not in the office yet, so he cannot do anything for the next 2 months. So come on, let's forget about it. And people started to buy. Okay. The problem is, as we have seen in the 5th of August this year, a sudden spike in volatility when everyone is sure volatility can be incredibly dangerous. So this is something that always needs to be on alert. Furthermore, if you think that if something breaks before Trump is officially president, it's actually very good for him, because there is no way he can be blamed for what happened in the market. There's no way he can be blamed for, market keeps going down during the first year of his presidency, but he can take a lot of credit for helping markets to recover and start a new run towards the end of this presidency. So while there is all this sense of calm around, VIX is super low, everyone is so positioned in December to enjoy some time, be on watch, because there are many people out there that effectively might benefit for a small correction in December. I wouldn't say a crash, because this market is too irrational. It's too euphoric. There is too much. The Fed will keep, keeping financial conditions loose. The Bank of Japan will keep floating the global economic system with liquidity. But the chances of a correction big enough so the blame of whatever happens in the future doesn't fall to Trump are actually not that small. And when everyone is positioned on the same side of a boat, and you start seeing a correction in the last month of the year, what do you expect all those people, professionals to measure, like people that manage people money for a living? Do you think that they will just sit there and let things unroll? Of course not. Turning risk off very quickly and taking money off the table to save your performance, and perhaps moving to cash might just help you to outperform the S&P 500 a lot if it ends up like going down meaningfully in December, is really the most logical move to expect from all the asset management professional crowd out there. But what happens if everyone sells at the same time? Yeah, that's not great. But as I said, no worries, because no matter like all the things that are surfacing, like the retail crowd out there is still so bullish and so committed to stocks that they are going to absorb some of the selling, as they constantly did till now, because, this is what happened every time in the last stages of a bubble. Okay. So, all I said today is mostly to help you organize your thoughts and give you like a good broad vision to approach the month of December, not just sticking your head in the sand, go levered long because everything is going to be awesome because of the Santa rally. I'd be on alert because things are not as set in stones as they look like. And in this particular type of market, it takes so little to spoil many people's plan. Be on alert and don't forget that we are at the very latest stage of what has been an incredible run. I mean, right now, even if the US economy accounts only for 26% of the world GDP, US market capitalization accounts for 50% of all the stocks listed in the world. In the MSCI World Index, 70% of the weight of the index is US stocks. And Japan has been not going anywhere since August. Yeah, there have been ups and downs, but it's been like a lateral movement. Europe is, having issues, is trying to hold it up, mostly because people hope that the ECB is going to keep printing money to inflate asset prices. China and Hong Kong, I don't even need to start there. All this hype and whatnot has been completely misplaced. So what's left is the US, okay? And you have a new incoming president that is going to be at his second and last mandate with nothing to lose and with many chances to make a mark in history and with all the interest to blame as much as possible for the current administration for the demise of the US economy. So, keep your eyes open, be open-minded. If market keeps going up, don't lose the chance to, if you have gains in particular, to take some money off the table. Don't be the bag holder, okay? Because as I said many times, in a bubble, 99% of the people always end up losing. Those that go short too early, they lose at the beginning. Those that stay in after the bubble bursts, because no one will figure out the bubble burst after the fact and after it's too late to make any meaningful change. So these people will end up like losing later, okay? So be open-minded. Don't, take everything for granted in December. Like, there are things happening around, strange things that are a bit odd for this period. Many gray rhinos out there. There is anything can really trigger a burst in volatility at any time. And in a global financial system, when people are short volatility, this doesn't look good. Furthermore, going towards year end, there are going to be more and more liquidity tension. And that's another element not to forget. So all in all, just play safe out there. Diversify properly, because owning the S&P 500 is not diversification when so much of the index is concentrated in just a handful of stocks that are incredibly overvalued by any measure, okay? And I will not stop reminding everyone, better safe than sorry, because the way things are going, maybe S&P 500 will hit like 6,000, 7,000, whatever. Keep running. But it's just like at this point, even the mainstream media cannot even find any more excuses to justify this. So I'm not sure how far we're from the end. I believe the shakeup is gonna really start in the next quarter, not yet, but who knows? As you know, I'm very prudent, and I hope everyone can benefit from, myself sharing like all these thoughts and trying to put everything on a table, not just, this tunnel vision narrative that is out there, so you can take better informed decision. Thanks everyone for listening to me today. Thanks as always for your support, for subscribing to my channel, for following me on Twitter, on Instagram. And I wish again, great Thanksgiving for all my listeners in the US. And I wish everyone a nice end of this long holiday weekend and a good beginning of the next week.